the core components of systematic investment. Now, the key word here is systematic. We want to create a system that creates regular returns. And again, the keyword there is consistent returns, regular returns. We don't want a one-off luck by chance kind of a situation. We want to create a business, right? And what I'm going to show you, or the components that I'm going to talk to you about right now, create that well-appointed system, the business system that you want to establish for your business of trading. So if for that, there are some key components that we have to take care of. And the first one of these is timing of the market, right? So we need to have a market timing strategy, an entry and exit strategy that is well appointed, well established. It leaves very little to imagination. It's completely subjective as against an objective view of the market. I think it's going to go this way. If there are certain parameters, certain characteristics, certain triggers, then you have to get into the market or out of the market likewise, right? So for entry as well as for exit, you will have certain triggers. Now, when one gets started in the business of trading, that's literally the first question that asks, what do I want to trade, right? And how do I want to get in and how do I want to get out? For me, this was the first stumbling block, and I'm sure it's the same for you, for all of you. So I figured that if I knew what stock to buy, what price to buy it at, and what price to get out at, either for a loss or for a profit, I thought that I could make money from the market. And as I will show you, this is only one of the components, one of the 4 components that go to make your trading system. But this is the first place that we start. I don't know what to buy. I don't know what price to buy it at. I don't know what price to sell it at. So if I can figure this out, I will be able to make money from the market. But your market timing strategy or your entry strategy is not the holy grail. I'll talk about what the holy grail is a little later, but this is not it, right? And to me, it doesn't really matter what strategy you follow to get in and get out of the market, what instrument you decide to trade in, what instrument you decide to buy, what instrument you decide to sell. To me, the more important aspect is to make sure that it is a repeatable system. It is something that is based on rationality. No emotions should be involved, and you will find the more emotion-based trading you do, the more difficult it becomes, to sustain, the more difficult it becomes to implement. So for me, the most important part of a market timing strategy is that it should be absolutely rational. It should absolutely be emotionless. It should be absolutely emotionless. It should be based on certain triggers that decide your course of action. And therefore, there should be an absolute trigger which tells you when you want to get in, right? That's the entry price, or what price you want to get in. Firstly, what instrument you will be trading in. And then what price you want to get in at, and what price you want to exit at. What price will you get out if it's a loss-making trade, or what price you will get out for a profit. So you have to clearly define your 3 price levels: the stop loss, entry, and target. I call it the SET. That's how we set our trades. The stop loss, entry, and target. A stop loss, this is where we start from, because this is really the first priority that we have, preserving our capital, right? So when you put in your stop loss, you're saying, okay, this is where I want to get out if I am wrong. And then you set the entry. Entry is the price you will enter into the trade. Whether it is going short or going long, doesn't matter. That's the price you have set for your entry. And finally, the target. The target is where you will get out if you're for a profit. Now, if the trade moves in your favor and you are making money, the last thing that you want to do is to look a gift horse in the mouth, and you want to take whatever the market is giving you, right? So at that point, and believe me, I've struggled through it. I know a lot of my students have struggled through it, where when you are in that profit-making trade, you know you should be getting out because it's hit your target price, but you don't get out because it's this emotion of greed that sets in. Oh, it's going to go higher. It's going to go higher. I'm going to make more money. And so you hold on till that point when it starts falling, and you don't want to take you don't want to take less of a profit, and so you hold on a little longer, and before you know it, it's back at break even, or worse, you're making a loss now, right? And that's really where the roller coaster starts. You don't want to be in that. And that's really what I want you to guard against. I want you to make sure that your emotions are removed from that system. So you set your target price. That target price is where you will be getting out for a profit. So all 3 parts, stop loss, entry, and target, that has to be defined, and it has to be defined before you get into the trade. So for the purpose of our investment system, for our trading system, and subsequently for our trading plan, these are the criteria that I want to make sure that you've addressed. Firstly, a rule-based entry system, a clear black and white way to enter and exit the market. Secondly, specific stop loss, entry, and target. I've already stressed on this. You have to have these levels decided before you get into the trade. What this means is that there's no ambiguity. There's no there's no confusion at what price you will be getting out at. You can have multiple entry points, you can have multiple exit points. That's not a problem, but it has to be decided before you get into the trade. If you're one of those who believe that I want to average in, that's perfectly fine. But at what price are you going to average in? At what price are you going to get in? 50%, 25%, 100%? How are you going to base your entry, as well as how you're going to base your exit? At certain point, people like to get out when it reaches a certain level. You want to make sure that your stop loss is now at your entry price, and so you're not ready to lose money to the market. So you sort of make your trade a break-even trade, and that's fine as long as you pre-decide that. That's the point. That is your rule that will go into your trading plan. Personally, I prefer to have a single entry and single exit, and I'll talk about why I do that, but I leave that up to you. If you feel comfortable with that, that's absolutely fine as well. And thirdly, in that order of importance, what stock are you going to buy? What instrument are you going to be trading in? Is it going to be the cash market, futures market, or if you want to get into the options market, whichever it is, whether you want to go into commodities, equity, that's entirely your call, but you have to decide that beforehand. I typically have a list of stocks that I want to be analyzing on a day-to-day basis, and I have that ready, and that forms a part of my trading plan. If you have that list, well and good, I would strongly suggest that you make a list. If you have only a handful of stocks that you want to trade in, that's also fine. If there are certain triggers that you feel that you want to base your stock selection on, that also is fine. So for example, you feel that, there is, the oil prices have changed, and you feel that the direct impact of those oil prices is going to be on certain key industries which are dependent on oil. For example, airline industry, transportation industry, even the vehicles market. If you feel that they're going to be affected, and therefore you'll be looking at those stocks, that's fine. There is still a little bit of ambiguity in that. There's still a little bit of emotion-led decision making with that. So I am not always comfortable with that. But if that's what it is, you want to try it out. Be aware of any emotions that you encounter. So for example, when you're doing your analysis, you be aware of whether you are selecting a stock or selecting a particular script because of a certain emotional bias. That's what I really want you to guard against. The key word is I want it to be unemotional, right? There should be no emotions attached to any of your decision making. I will explain why in the next parameter, specifically in the risk management section. But at this point, make sure that there is no ambiguity attached to your decision making. Now, in the business of investing, as in any other business, you make money by buying at a low level and selling at a higher level, right? So that's you buy low, sell high. And that's really how you make money. You buy at a wholesale price, you sell at a retail price. You buy raw material, you sell finished products. In the business of trading, you do the same thing. You buy low and sell high. But in the quest for finding this holy grail, I spoke about that we feel that the holy grail of investing is in stock selection, buying at the right price and selling at the right price. And I will show you why that's not really so. The holy grail is completely something else. But in looking for this holy grail, investors, and myself included, have spent countless hours and a lot of more money in finding that perfect strategy. But for our purpose, I don't recommend any specific strategy. As long as it meets the criteria that I've set, I'm absolutely fine with it. You can even have multiple strategies, right? You can have strategies based on fundamental parameters, technical parameters, anything. But as long as you manage those strategies independently. As a hedge fund, we are constantly looking for and developing new strategies. But at any time, there is a sequence that these strategies go through, an onboarding sequence, if you will, to make sure that we have looked at the strategy and we know exactly what we're getting into before we deploy these strategies. So yes, you can have multiple strategies. Make sure you manage them independently. So even though we're developing new strategies all the time, what is more important is creating the system to deploy these strategies. So I always recommend the following steps. Number one is creating or finding a strategy. Right now, you can do it yourself. You can create one yourself if you feel you know what to look for and how to do it. Or you can find one. You can absolutely borrow it from other people who are willing to sell it or even lend it to you. The second is to make sure that it meets our minimum requirement, right? An absolutely unbiased, emotion-free decision-making process. What stock to buy, what price to buy that, what price to sell if it's going for a loss, and what price to sell when you've made your target. And then we have to backtest that. Once you know the strategy, we need to make sure that it is giving you the results that you anticipate. So by backtesting it on historical data, you are able to understand what kind of returns you can expect and whether those returns are within an acceptable level. And then, of course, once you know that you've reached an acceptable level, you want to go into what we call forward testing or paper trading. Here, you're not actually deploying money in the market, but you're taking the trades in the live market. So there are a number of softwares that do this, that track your trade. They link to the market data, and so therefore they know exactly when you have placed the trade and what the price at that level was, and therefore they record the trade as if it was an actual trade. But there's no money being deployed in the market. What this does is it gives you a real world situation of your back testing. So in back testing, there are a number of that it's not possible to track those things. In forward testing, you're able to track that because you're actually mirroring live trading. And once these results are in line with what you were expecting, or you've made the changes to the business plan, to the trading plan that are required because of these nuances in trading in the live platform, you are ready to go into the next stage. And the next stage, of course, is investing in the real market, but with limited amount of capital. So you want to start off with something which is absolutely acceptable, which is something you can live with, even if you're to lose all that money, all that capital. That's perfectly fine. You deploy it in the real market with limited amount of capital. Again, the idea here is to see it work. When you see even a little amount of returns from that limited amount of capital, you can, by just, working out the actual returns, the average returns or percentage returns on your capital, you can see whether this strategy is going to work in the future or not. And then finally, going live with full capital. So you're jumping in now, but you've done all your homework. You know exactly what you're going to do. You've already looked at the possible problems that you will face. Maybe stop losses become an issue. Maybe slippage is an issue. Maybe getting a full fill, with the quantities that you're trading, that could be an issue. So these are the things that you have ironed out in the previous stages, and now you're ready to deploy your full capital. And this is the stage, again, you want to make sure that you have a way, and we'll talk about that a little later, of getting into the market as smoothly as possible. If possible, no jerks should be there. What do I mean by that? If I am, for example, trading with a lakh of rupees of capital, 1 lakh rupees of capital, and I suddenly jump from 1 lakh to 20 lakhs, there's a big jump. This jump is not necessary that my emotions are in place to handle this kind of jump, because as soon as this jump happens, the per trade loss or the per trade risk increases dramatically. If my emotions are not conditioned, if I haven't seen this work enough, I'll talk about this more in depth in the emotions of trading phase. But here, really, I want you to be a safeguard as to what you want to look at in terms of the deployment of capital. Try, if you can, to ease into that. From 1 lakh, maybe go to 5 lakhs, to 10, to 20 lakhs. Don't jump from 1 lakh to 20 lakhs. In my experience, this has been a big problem, because a lot of times, as soon as you increase your capital, a couple of losses are guaranteed. It's just that's just the way it happens. Call it Murphy's Law, whatever. But that's what happens. And when that impact happens, all your previous profits, obviously they were small, but all those previous small profits get wiped out, and you go into the negative. From a positive investment account into a negative investment account, it takes a bit of maturity on the emotional side. And in my experience, again, it's better to ease into the system. So that's something that you want to be aware of as you deploy your capital. And finally, monitoring. Monitoring is absolutely essential. It's like in other businesses where you have audits, right? Or regular audits or regular accounting, that internal audits, where you are able to understand whether things are going exactly the way you are thinking that they're going, right? So you look at the numbers, look at your books, see where you made mistakes, if you made mistakes, are the returns actually what you're looking for? And there's a consistent track on the books, on the numbers, because at the end of the day, that's where your profits are going to lie. And we are in this to make money. We've already established that we are here to make money, and that's the end goal. So monitoring is absolutely essential.